Hey guys, welcome back to the channel. In this video, we're going to be going over my portfolio, and I'm going to be just kind of giving you guys my thoughts on diversification and why it's so important, especially now during all this turbulent times. All right, so real quick, let's just take a look at the S&P 500, which has been absolutely brutalized over these last couple of weeks, right? So if we look at the 1 month, we see that we've dropped 6%. Now, whenever an ETF moves about 1%, you can tell that it's, either going to be a great day or a very bloody day if you're investing in individual stocks. If you held this ETF and you had like a hypothetical $100,000, I mean, you'd see like a 6% drop, a $6,000 drop, which honestly is not that big of a deal, versus like you see things like Palantir or Nvidia or Meta or Google, they're dropping like 20, percent, sometimes 15%. That would be a little more scarier. Okay. But anyways, I just want to talk about kind of why diversification is so important, especially now when we're kind of in correction territory, right? When we're, everyone's freaking out. There's YouTubers all over the place that are kind of selling out of things. People are worried. People are, married to one strategy over another, and they're seeing that strategy in a correction or a bear market is, starting to show some cracks, things like this. So I just want to show you guys kind of my portfolio, give you guys my thoughts on everything, and maybe you'll be able to find some value in this. So anyways, let's take a look. So right now, this is the income portfolio. This is actually a core portfolio. I need to rename this, but it's sitting at $370,000. Okay. I recently bought VGT not too long ago. February 21st is when I bought it, and then I put $170,000 into it, and then that's when the market started to take a poop. And as you guys can see, I'm almost down to $150,000. A $17,000 loss over a couple of weeks is definitely a little scary. I'm not gonna lie, but I'm not worried. I'm not worried because I'm very diversified in all of my holdings. Okay, if we look, you guys can see REITs. These are real estate investment trusts. This is a completely different asset class than, equities, the stock market, or even, something as, specific as like a tech sector ETF like VGT. All right, VGT is a ETF that holds 300 different companies. So there's instant diversification there, which is what I like, right? I didn't want to have to pick and choose individual stocks. Instead, I wanted to go with an ETF that's very broadly diversified, and I don't have to think about it. I don't have to research individual companies. I don't have to be worried about its CEO, doing a Roman salute and then the stock price completely plummeting after that, right? I don't have to worry about any of that. For REITs, this is where I pretty much cut my teeth on because I do a lot of research on REITs, on real estate in general, and I like REITs. I like their prospects. I like how they can create long-term wealth. So even in my REIT portfolio, instead of going with something like VNQ, which is the Vanguard Real Estate Index ETF, I wanted to pick and choose my own individual REITs to build this portfolio. And the reason why I did that was because VNQ holds a lot of trash companies. It holds a lot of like mREITs and, just zombie REITs and REITs that are just destroying shareholders and, just doing a lot of dumb crap. So anyways, I wanted to choose my own individual REITs, but I wanted to take it a step further, and I diversified even amongst my REITs. Okay, you guys can see there's cell towers, apartments, industrial REITs, and you guys can see for yourself the returns so far. Apartment REITs are outperforming cell towers. They're outperforming industrial, right? Storage REITs is doing very well, outperforming triple net lease and industrial, right? What you will not see in here is office and malls, right? Because I'm very against that. But something like a VNQ or any other type of REIT ETF would hold that stuff. So I opted against them because I didn't want to invest in them. So anyways, this is this portfolio. And again, this is very diversified. So even if cell tower REITs were to take a hit and, they would be down for about, maybe a year or something, apartments are doing very well. Apartments are doing exceptionally well because of all the macro stuff that's happening in the bigger picture, especially with, the talk of tariffs and everything. We can't get enough lumber, interest being high, interest rates being high, which means that, home builders can't build. New apartment communities can't come online because, we can't get the materials and everything costs too much. So now there's going to be this lag. And while there's this lag, the apartment REITs that I own, they already own the buildings, they already own the community, so they're going to see an influx of renters, right? So that's a tailwind for them. That's good for the REITs, right? Anyways, moving on. So this portfolio, again, this is my core portfolio. This is the portfolio that I'm going to have a 10, 15, 20-year lens on. I don't plan to ever sell out of tech, and I don't plan to sell out of the individual REITs unless my thesis for them changes. Whereas, technology ETF, it's just broadly diversified. I don't have to pick and choose anything. The REITs, I'm not married to any individual REIT or any individual strategy. If something changes in REITs or in the REIT, individual REIT, then I'll just sell out of it, right? And then probably reallocate that money or hold it and wait for a better opportunity. Okay, you can see BDCs are actually doing very well. They're probably doing better than all of these asset classes, right? 65%, right? 65% up, doing very well. Crypto ETF is fairly new, so again, don't use this as anything. But again, I wanted more diversification in the core portfolio, and that's why I have a crypto ETF. The companies is more of a joke, so just ignore that. But what I also have that you don't see here is a cover call income portfolio. So we'll take a look at that, right? And I want to explain this even more because I'm diversified even here. Okay, this portfolio is actually sitting at $170,000, right? I have a lot of margin on this. This isn't a video about margin or margin stacking or anything like that. I just want to explain kind of the idea behind this. Okay, so you guys can see my individual picks. I have a little bit of crypto, cover call ETF, YETH from Roundhill. This is PLTW, which is a 1.2x leverage ETF for Palantir, which is an AI stock, right, for the defense sector. And then you have xdte. Let me pull out. There we go. xdte, which again is a S&P 500 cover call ETF, and then xpay, which is a target 20 distribution ETF for the S&P 500. So these are my two biggest holdings right here, xdte and xpay. And if we see your equity, so you guys can see 63,000. Really, these were 65. So these are the biggest positions in this portfolio. And I went with the largest positions for these two because of the underlier, which is the S&P 500. And as I showed you guys just a few seconds ago, this drops. When this drops, this doesn't drop by much. Yes, 6% is a lot. But in the broader scope of things, if we look at something like, NVIDIA stock, if we look at like NVIDIA stock, you guys can see that over the last month, this thing has dropped 15%, almost 16%, right? If we look at something like Meta, which is another technology stock, it's Facebook, if we look at that, again, this drop is just as substantial, 15%, okay? I didn't want to have to deal with that, so that's why I went with xdte and xpay as my cover call kind of positions, except xpay is not a cover call position. Well, it is cover call position. It's a long cover call position. PLTW, again, 1.2x. I actually did a whole deep dive on Palantir, so if you guys want to see that video, just check some of my older videos. But I want to explain this portion to you guys. This is very diversified in my opinion. I'm sure there will probably be some others out there that will probably gawk at this and say that's not diversified at all, but I just want to explain my reasoning. So both of these track the underlier, the S&P 500. Okay, so that's a big deal because the S&P 500 is very broadly diversified. When it drops, it might drop 1%, it might drop 2%, right? If it drops 20%, like we saw during the C19. If it drops during that time, that means the entire market is probably dropping 40, 50, or 60%, right? That means like individual stocks are dropping that much, right? So there's some downside protection when you invest in something like an S&P 500. They're broadly diversified. They're capturing the entire market. Whereas PLTW is a single stock exposed ETF, right? This is probably my riskiest position, all things considered. The Ethereum cover call ETF is probably not as risky as this one. And the reason is because this one's 1.2x leveraged ETF, meaning 120% of the upside and the downside. So you got to think about that as well. But with cover call ETFs, there is some downside protection because you're still making money on the downside, right? On the premiums while it's going down. So this one is a little more protected, YETH, over PLTW. But again, this is very, very diversified. in my opinion, right? These are my small satellite positions versus my two big core positions. Okay, this altogether, the 65 and 65, so that's what, $130,000 versus the $40,000 in these higher risk positions, right? This is the core satellite approach, and this is the approach that I took with cover call investing. All right, so again, diversification does matter. Diversification is very important. And when I designed these portfolios, I didn't want to just invest in every little single thing. Let me bring back this one. All right. And I'm not taking pot shots at anybody. Everyone's, investing style is different. But some people have this list loaded with nothing but cover call ETFs. That, in my opinion, is probably a little foolhardy because we don't know, and we're starting to learn, especially during this market correction, how cover call ETFs are actually performing. And a lot of people are being caught with their pants down. So, and they're starting to learn that, oh my God, cover call ETFs offer almost no protection to the downside, and they're just losing lots and lots of money. Again, so I wanted to go with, diversified ETFs, i.e. the S&P 500, with a smaller allocation to single stock exposed ETFs. This to me is diversified enough. If I wanted to invest in another, single stock exposed ETF, I could, but I'm not going to do that right now because of what's happening in the broader market. This one, like I said, PLTW, I understand Palantir. I did a lot of research on Palantir myself, so I'm very bullish on Palantir. So I'm just waiting for the thesis to play out for the market to catch up. And then, I'll probably swing trade this one, hold it for a little while, maybe 3 to 6 weeks, maybe 3 to 6 months, and then sell out of it, hopefully at a profit. Meanwhile, the YETH, again, similar thing. It's going to be more of a swing trade, maybe a little longer duration, depending on how Ethereum acts, but I'm still making income off of it. And, the downside protection is there. It's not going to fall as hard as, holding Ethereum itself. So this is how I designed this portfolio. Okay. I had diversification in mind when I initially built it. All right. So, that will do it for this video, guys. Again, I just wanted to show you guys, the portfolios, why diversification matters, and kind of, you guys can surmise from, everything I just told you why it's important. The market is really choppy right now. A lot of people are selling out of stuff at huge losses, and I think it's probably going to get a little worse. If you guys didn't know, I do YouTube lives Monday to Friday, most times at 8 p.m. Eastern Standard. So if you guys want to get in on those, please do. Always welcome. I talk about, the latest finance news and kind of just my thoughts on how everything's going, and how we as investors can probably better position ourselves either to protect ourselves or to take advantage of, the situation, because at the end of the day, we all just want to make money. Another point to all of this is there's 100 different strategies for investing in the stock market, and no one strategy is better than all of them. I don't even index investing. Index investing is touted as the premium one, but so there's investors out there who say they can beat the market returns, and they have been beating the market returns for a very long time. So I don't know. You guys tell me, right? Which one is the best strategy? And then there's others who are just full blown all in cover call ETF income investing. They only invest in dividend paying growth stocks. There's some who are just invested in cover call stocks or cover call ETFs, and then, et cetera, et cetera. There's like 100 different ways. And there's some people who are just completely overly diversified. They'll have gold, they'll have treasuries, they'll have bonds, they'll have real estate, they'll have equities, they'll have international, they'll have small cap, large cap, mid cap. Like, they go really deep into this stuff. But again, no one size fits all, and every investing strategy is going to be different. But I think at the core of it all, the more diversified you are, the better you'll be, especially right now when the market is going through a very, very turbulent time. And it probably will be going through a very turbulent time for the first quarter of this year, in my opinion. I don't know. I'm not a financial analyst, a financial guru, or anything like that. I'm just some dude on YouTube who's giving you guys my thoughts on everything. So with that being said, guys, I hope you guys got some value. Please let me know down in the comments what you guys think about diversification. Are you investing in a diversified portfolio? Are you concentrated in only a few positions? What are your thoughts? I'd like to hear you guys. All right, guys, take it easy.